I think we're going to start calling this YouTube Live, Dan. Yeah, it's not doing much. Well, it's going down. And Facebook is terrible. All right, everybody, let's get started. I couldn't get this YouTube going anyway. Welcome, and today we're going to be talking about covered calls. And are they better than buying a stock alone? But you can buy stock, and if you don't know what covered calls are, that's something that we're going to discuss, and how to utilize them and how you can use them to increase your wealth if you use them intelligently and at the right time, of course. So let's start moving on to that. Dan, how you doing?
Hey, excellent, Greg.
All right.
As always, we have a fantastic webinar here for you today, as you said, on covered calls, and we're going to approach them in two perspectives and answer the question of when do you use them, why do I use them, what is my upside and downside versus just trading stock alone. And at Master Trader, everything starts with a bias of the charts. Are you bullish or bearish? And if so, how much? And then that dictates whether we recommend a stock or option trades, directional or income. And we're going to get into all of that today. And so actually with today's market weakness, this is actually a great example of when we would be legging into these covered calls, assuming that you were long stock. And we're going to show you the reasons why. So yeah, why don't we just go through? I have a couple slides here that I want to review first, and then we'll look at some examples. And then as always, we'll do some live scanning, both of the market and maybe some new trade setups.
Right. Let's give everybody an overview. So those that don't really have an understanding of what we're doing and why, give them the foundation, and then we'll show them how we can utilize that information.
Fantastic. So let's just start with some basics. We assume everybody knows what an option is, but just very simply, what is an option? It's a contract that allows the right to buy or short something for a specific time for an agreed upon price. And we have buyers and sellers of those that have different expectations for buying those calls and puts or selling them. So a call buyer, I'm paying money and I want to have the right to buy the stock. Just like buying an option to buy your neighbor's house. That's a call option and the underlying is a house, not a stock, but it's identical. You'd be paying your neighbor money for a specific amount of time, and that's whatever you all agree upon at the agreed upon price. So the call buyer has the right to buy that stock at that price or buy that house at that price if they want to. But guess what? They're only going to want to do that if it's gone up in value. Otherwise, it's going to be a worthless piece of paper.
Again, it's a contract. Right?
Excuse me?
It's a contract. So how do I get out of this contract?
Because it's a contract, and in the option world, the options clearing corp ensures the obligations of the option buyers and sellers. But this contract that we're entering into says right there in black and white, I have the right to do something. I don't have the obligation. And how we trade these contracts, because we aren't trading them with the next door neighbor on his house, we're trading them in the option marketplace. And that's through your software that has option quotes. And that's how we buy and sell these options all the time.
And so what is my downside?
Your downside when you buy an option is whatever you paid for it, it becomes worthless. So just like buying a stock, your maximum loss is always what you paid for it. Okay. And we're going to get. So when you buy a put, that means you are either speculating or protecting your position, just like buying insurance on your house of a fall in price. You have this put contract that is going to go up in value as your stock falls. So again, you can do that for speculation or hedging, and we're going to show you how we do that just by calling short-term tops and bottoms in the markets. So that's answered your question on option buyers. They have the right to buy or sell the underlying stock. The seller, which is taking the other side of that transaction, has obligations if you want to exercise your rights. So on a call option, and this is what we're going to be leading into in covered calls. If I am selling a call option to you because you want to buy my Apple stock, let's just say, then I'm putting money in my pocket and I'm agreeing that you can take my Apple stock from me at the agreed upon strike price. But the money that you're paying me to give you that right is mine to keep. And that's the benefit of selling options, is because the money that you receive on covered calls, as opposed to doing this as a brand new trade just for pure speculation, which we're going to get to towards the end of this, you're going to see that there's no downside to selling call options on stocks. There's only one possible negative.
There you go, Dan. I knew there was going to be something in there somewhere. I thought you were going to tell me how to make free money. Well,
there's no free money, but using the charts, we like to refer to them as no-brainer trades. And, we're going to show you how to leg into these positions. But the downside of selling a call option is, yes, you're putting money in your pocket and allowing somebody to buy your Apple stock from you, but you're capping your gains. So that is how we're going to use chart patterns to time our entry in selling covered calls. So we can sell a covered call right out of the gate, or we can leg into it. And I'm going to show you both of those. So just a little bit more so we can focus in on covered calls. So the call buyers, we said they have the right to buy something. The call seller, so that's what we're going to be talking about today, since we're talking about long stock versus covered call. BC, what's the downside for selling covered calls? There's only one. I call it a potential downside. It's not even it's a potential downside, and I'll explain why. You're capping your gains. You're possibly capping your gains. And they'll be crystal clear when we get into a bunch of these examples. But, ask me again if it's not fully answered later. So we're putting money in our pocket and agreeing to sell our merchandise. The money is 100% profit. Actually, from a tax perspective, it just keeps lowering your cost basis, but it's profit. So this has a higher probability of profit. What does that mean? Higher probability of profit. It means from entering the trade to exiting the trade, covered call versus just buying stock alone. Covered call has a higher probability of profit by definition, because we're lowering our cost basis, which I'm going to show you. So as you see there, the only potential downside is capping your gains, but everything starts with the charts with us. These are all pictures of different flavors of when we would leg into a covered call. When we make a directional bet, so this is Greg. Greg's like, I just hit the buy button and I'm long stock. It's black and white. Greg's making a directional bet and I want to get rewarded for that bet. I buy stock. That's fine. We do that all the time. Could you put on a covered call position at that same time? Absolutely, you could. You buy Apple stock. I'll just keep using that as an example. Apple's at $208.81. You can buy the stock and immediately sell a call option against it. And Greg would be paying $208.81 a share. And the premium that I get is going to lower my cost basis. And lowering that cost basis allows the stock to go against us and we still make profit. So that's a long answer to higher probability of profit. Greg is only going to make profit if he sells Apple at greater than his purchase price. The premium that I take in on selling a call, Apple can go against me by that much and I'm still profitable. So, you know, we're going to talk about credit spreads also, but this is what we're doing in legging into covered calls using the master trader approach. We're going to wait for momentum to slow. And we're going to sell these calls at or above resistance where we don't think the stock is going to go because it's tired. The momentum is slowed, but it doesn't warrant closing the position because we're still bullish on Apple. And this is why this is a fantastic way to continuously bring in money on stocks you own when they're consolidating and momentum is slowed. So that's how you can turbocharge your returns with covered calls.
Dan, let me give them a little different flavor of doing exactly that and how, well, I could have used it yesterday. Yesterday, I bought Twitter. And regardless of the price, it's not the kind of stock that you would own and sell a covered call on because you think you can bring in that extra premium and lower your cost and based on the patterns that we'll look at. However, had I done that, regardless, I could have sold a slightly out of the money option and lowered my costs, not by much, you know, maybe a dime. Not a big deal. But I still could have taken in some money and the stock is down a little bit right now and my cost would have been a little bit less. Now, I only bought it because I thought it would go up. Now, it didn't have to go up tomorrow necessarily, being today, since I bought it yesterday. But in any event, my downside risk, if it went up, would have been, like you're saying, just limiting my gain at that time. You know, this kind of a pattern, there isn't the kind of premiums in there as it would be as if we're doing it the way we're going to approach it, meaning the stock was already going up.
Correct. Actually, you know, I used Apple as an example. I'm actually in the position. I have a covered call right now. So this is a very timely lesson because Apple, along with the market, is, you know, having, you know, gap down and is weak this morning. And so I sold an out of the money 210. Maybe we should wait till we have charts later, but I sold an out of the money call on Apple for like 93 cents a share. And it expires this Friday. So with Apple at 208, you know, 80, I'm putting 93 cents a share in my pocket, which is lowering the cost basis. And it's still agreeing to sell it at 210, which is, you know, $1.25 higher. So I have a higher probability of profit now. And then I just typed an answer here to BC. that when we do these covered calls, we do them when the chart pattern suggests a retracement, stall in momentum, and just consolidation. And we want to get paid while the stock's retracing or consolidating. If the stock subsequently turns more bullish, I can just buy to close the short call, so I'm not capping my gains anymore. So that's why I'm saying there's no downside, in our opinion, to covered calls, using the master trader approach, that is. And you know what, Greg, I meant to grab this slide to show. There are a number of covered call funds out there that actually, if you're in a stealth bull market, they underperform just the spiders themselves, because they're just routinely, and not looking at charts like we do, capping their gains at the worst time. So let's just move forward with these charts, because, you know, a picture's worth 1,000 words, as they say. This is Amazon. So notice the start area, big bearish engulfing bar after a lower low and lower high on the daily chart. But it's still in a long-term uptrend. So on all these examples here I'm showing you, assume that you're a long-term investor and you're just wanting to leg into these calls to put money in your pocket and reduce your cost basis. So notice where that star is, and let's just say this stock closed at 1,500 bucks. Well, I know I have it there at 1497. You go to the option table and you pick, and we teach you how to do that, of course, you know, based upon your bias of the stock and your trading time frame. But in this example, we're saying 24 days to expiration. I'm going to sell a call option on my Amazon stock. At what price, you ask? Well, using master trader technical analysis, let me ask Greg. Based on that big, ugly engulfing bar, what do you think the odds of this retracing and going back above 1,600 is in 24 days?
Wow, Dan, I thought the price was going to be lower than that. I would bet your life it'll never go above 1,600 in 24 days.
Well, okay, so yeah, you're pretty confident. So let's look at this math, folks, and hopefully you're going to start salivating. We went to the marketplace and we decide what strike price we want to sell our merchandise to the public. And then we ask ourselves, am I willing to sell my merchandise at that price in exchange for the premium that is being offered me? I have it in the red rectangle on the left. You can see the $1,600 calls. I'm selling them for $17.90 a share. You do the math on that, and I'm reducing my cost basis 1.2%. And the stock is $103 higher than it is right now. So even if I do have to sell my stock at 1,600, I mean, I don't have to unless it gets assigned, because as I said a few moments ago, you can always buy the call back. So I'm still making $103 on the underlying, right? 1,600 less, it closed at 1497. And I've put 1790 in my pocket. So I'm still making an additional 103 plus 1790. And this example, it expired worthless. So that's 1790 a share, pure profit.
So Dan, there's a question here. You're just looking at the technicals? You mean you're not looking at fundamentals? BC, I made the assumption in this lesson that you're just a long-term bullish bias on the underlying for whatever reason, technical, fundamental, I don't care. We're showing you today, comparing just buy and hold stock to legging into covered calls, the master trader way.
But master traders' approach to the market is we're investors and traders, and we do it based upon technical analysis and a little bit of intermarket macro analysis. But no, you will never see us looking up a fundamental balance sheet or any of that nonsense. That's not what makes stocks move. What makes stocks move is an imbalance of supply and demand, which is 100% reflected on the charts. So that's all that matters to us.
Yeah. But the other thing, BC, and is that while things like earnings coming out definitely going to affect the price and what people do, which we're going to be aware of and not going to be doing something like this, possibly. We might do it after the earnings are report, especially if it gaps much higher. But these options can be sold, especially something like Amazon, could be several days, could be 20 days, it could be 40 days. So let's just say, for example, it's going to be for 10 days. I think in your example, Dan, it was 24 days in that Amazon.
Correct.
Right. So how are the fundamentals, if you believe in them, going to really change the price of Amazon in 24 days? Unless earnings are coming out. No. So that, okay, the fundamental piece of information is going to affect the price. But in reality, other than that, whatever they're making and their earnings per share and, their cash flow and all of those things, not going to make any difference in a short amount of time.
And secondly, fundamentals are important in the long run. Obviously, they're going to, dictate survival. But there was a lot of Fortune 100 companies that are in the graveyard right now. Enron was a Fortune 10, and I watched it go from 90 to zero. A couple more examples. Shop. Right where I have the star there again, go to my option table, pick what strike and expiration meets your trading plan. When the stock was at 145.45, we sold $10 higher, or $9.55 higher. We took in $3.40 a share. Do the math on that. That's 2.3%. Additional return on your investment for 29 days. Annualize that, and it's 15%. And that's it. That is yours to keep, whether the stock goes up, down, or sideways. This premium is yours to keep. Now, if the stock keeps falling, of course, your underlying bullish stock position is going against you. But that's not the focus of today's show. Today, we're showing you how to use legging into options to turbocharge your returns. So there's another great example. Another example, Netflix. We had a breakout failure at the high there, consolidated sideways, bearish engulfing. That is my green light. Greg, what do you think the odds of this going over? That's your old line, the red line at 320.
Get rid of that. Yeah, sorry.
Yeah, no, but that's fine. Even use 320. But in my example, I'm using 340. So I'm saying at $300, I'll let you buy my Netflix $40 higher. Okay, how much are you going to pay me for that? Almost $6 a share? So I'm making, if I get called away, I'm making an additional $40 plus $390, the premium I took in. I'm sorry, $590. So that's 2% for 24 days. It's like a no-brainer. So when I hear somebody say, but Dan, I don't want to cap my gains at 340. I have all kinds of reactions to that. One is, are you an idiot? Are you a novice? Do not understand this. 2% additional return in 24 days, annualize that. And we're using charts to maximize our confidence of not capping our gains.
Dan, so question was, with Netflix example, when do you buy your shares so you could do the covered calls?
Excellent question. And actually on United Airlines example, I do have an arrow where you could do that. But to answer your question,
could have bought them anywhere.
Absolutely. To answer your question is show me a master trader bullish entry. And I see a beautiful one right there at the tail end of 2017 with a bullish 1, 2, 3, coming out of that consolidation. So that's the answer.
All right. So wherever you bought them, BC, whether it was there or you bought it here or you bought it here, the idea is, okay, or you bought it here on the pullback, you've got a profit in there and you're willing, as Dan is saying, I'm willing to sell a call option where the strike is up here at 340. And we've got a pattern that says, this is a very bearish pattern right here after a breakout failure and a break lower. And we're saying, hey, in 24 days, what is the likelihood of it going back up here? And we're saying this pattern does not suggest that. So we sell that, take in the extra almost $6 and wait. And if it did go up there, as Dan said, you still have that additional profit from here to here that it got to $40 and you've taken in another $5.90. So your downside is, well, they're going to take the shares and maybe it goes to 360.
Right.
So you lost, in a sense, profit that you could have made if you did nothing.
But we teach in our courses how to manage that back with the charts. So Greg, also in late January, if you can show them the arrow, the double-edged arrow there, that was another place where it got climactic. And it's not as bearish as the start area that we're talking about, because it's still in a strong uptrend. But when the rubber band gets climactic to the upside, that is another great time, because the premiums after rallies and sell-offs increases. So when we go to the option quote screen, this is a picture of greed. It was probably all over CNBC. They had good news. Whatever. That's a picture of good news and greed. So the premiums, where Greg just marked, are very high. So it's like we're feeding the alligators that are hungry. We're saying, yeah, I'll let you buy my Netflix at inflated prices for a big juicy premium.
So, and here's a great question that Dave asked. Dave, how you doing? It's been a long time. Why would you want to hold the stock when it's showing signs of weakness in that bearish pattern?
So thanks for asking again, because it's a very important question. I'm starting with the assumption that you're longer term bullish. So maybe like I've said in Amazon and even this, I'm assuming that the weekly and monthly chart are still bullish, and these are longer term trades for you. But you're absolutely right. If you think something looks like a short, then just get out of it. So legging into a covered call is still a bullish position. If you lose that bullish bias, get out. Totally agree.
So here's a tip for those of you saying, well, how do I know it's bullish longer term? Well, just by looking at this chart, we can come to some conclusion that it is, because that 50 MA, the green line is rising, which is equal to a 10 MA, right? 10 MA on a weekly chart. So that's rising. The weekly trend is up. This 200 MA is roughly about a 10 MA on a monthly chart. So the stock is a little extended, but it's strong, right? And it's in an uptrend. And there are other technicals that we would look at, but trading and investing, whether it's fundamentals or technicals, it's based on a belief of what's going to happen today, tomorrow, next month. And the strategy encompasses some longer term views as well. Right? We're not day trading here.
Right. Yeah, covered calls is not a day trading strategy, correct? Yeah, I could show you dozens of examples, but here's the S&P 500 ETF. Actually, BC just asked, can we do this on ETFs? Without a doubt, as long as it's optionable and liquid. Make sure all options you trade are liquid. We've recently we're in ITA, which is the aerospace ETF, and it's too illiquid. Things like that don't do. All of these spiders, diamonds, Qs, XLF. I mean, there's plenty. The oils, XOP, XLE. There's many very wonderful liquid ETFs. So spiders here. Again, that's a picture of greed. Had a breakout failure at the dead high there. Then a gap down sideways. That next day would be your time, if you were a long-term investor in the spiders, to sell calls against it. And, there's another blue arrow over there, a retest. So that's legging into them. Here's the example I mentioned BC is just a beautiful setup. So you can see United Airlines here on the bottom left. I'm saying hypothetically, you buy 1,000 shares on that breakout, and we're waiting for momentum to stall. So you see the first letter A was a retest of a prior high and a topping tail at major resistance. You can look at my little T chart there. Sell the way out of the money. It's $78 calls for $1.42 a share. So that's why the credit is $1,420, because on 1,000 shares, you sell 10 contracts. One contract represents 100 shares. So I'm putting $1,420 immediately goes into my brokerage account. It's mine to keep. My only legal obligation for putting that money in my pocket is agreeing to sell my United at $78 a share anytime within the next 28 days to expiration. That's my legal obligation. But if I bought the stock, just eyeballing it at $57, and a few months later I'm selling it for $78 plus $1.42, so I'm in essence, my CPA is going to say, well, I lowered my cost basis, so that extra $1.42 a share, total profit.
The patterns are extremely important to the strategies that we're talking about, meaning 99% of the time, I would say, the stock's going to be going up and then show some sign of failure at some point. So the fact that it's going up is increasing the premium in those call options.
Great. Let me interrupt you because you used the word failure. Is that a correct term?
Sure, because we're looking for some indication. Failure could be one day.
Oh, right. So I wanted you to define failure. The uptrend didn't, the pattern is still intact, but momentum is slowed. Something is saying that it's out of juice for a while.
Yeah, there's a lot of ways to look at that. That could be a whole nother webinar, but that we look at how something fails short-term, long-term, and an indication of that. So we always say price patterns have to be put in the context of a location, which increases the probability that the message is true. It's not lying to you in a sense. So yeah, when I say failure, like that topping tail, is a type of failure. It was tried to go up and it couldn't. It came back down. Now it went from support to an area of resistance and then failed. And this is where Dan is saying, hey, what's the odds of it going up here and I can take in that extra money?
$1.42 a share.
Makes sense.
And then we did it again. The stock's still in a bullish uptrend on the daily and weekly and monthly, even though I don't have any moving averages there. It's in a trading range, folks. And look at the math on the bottom of the T chart. We've lowered our cost basis 5.8% in 2 months. That is astronomical. That's how we get paid on your bullish holdings when momentum is slowed. That's the gift we're sharing with you today.
Right. And what Dan is saying there was our bullish holdings, which means these are stocks that have been going up. They look like they'll continue to go up, but based on the technicals that we look at, it suggests they're not going up over a short amount of time now.
Correct.
So we take in some money for that.
Right. And because options are a time wasting asset, the money that the call buyer is paying is expiring day by day up to expiration. So the stock has to move for the option buyer or they're going to lose their investment. And that's why we love selling those options using the charts, because that time decay is our daily profit. A couple other miscellaneous points here. So our goal is we want the options to expire worthless. So we're making 100% of the maximum gain and the option buyer loses. So we've talked about this a little bit. If you're happy with the calculated return on all these examples I just went over, and you don't mind being assigned, meaning your stock's going to leave your account on expiration day or weekend, if it's in the money, and then your broker's going to pay you the agreed upon strike price, then you do nothing. Then it was a home run trade. As we were saying, if you don't want your stock to get called away, if any of those bearish patterns that we just reviewed with you then start turning more bullish, then you just close the short call. And it's impossible to lose money on it, the net position. Because even hypothetically, you had to close out the short call at a small loss, you still made money on the underlying, because the only way it would be a small loss is if the stock kept going higher. So that's why these are just win-win trades. But we call a covered call a mildly bullish position because we are agreeing to cap the gains. Whereas when you're long stock, you're 100% bullish. And that's the trade-off, that you have to make an assessment of the charts. The time frame that you're using will dictate the frequency. Greg and I have a great option layover program that we consult for hedge funds, high net worth individuals. Some of them say, do them weekly, sell weekly options on our spider positions. Some say, I love the monthlies. And, some folks say, every quarter, just go slower and pick your turning points and sell me some quarterly options. Discuss with your CPA. If you do have a long-term holding, I don't want anyone mad at me saying, oh, I triggered a huge tax because now since it got called away, then I got a tax bill. So talk to your CPA about that. Now I'm going to take that same concept that we just talked about, and I'm going to just go over a few slides here with you before we do some live scanning of showing you how we use that exact concept of picking tops and bottoms but we don't own the underlying. We're just wanting to sell these options and credit spreads around short-term turning patterns to put money in our pocket. So, I mean, we keep it simple. This is the only thing stocks can do. They go up, down, or sideways. We're just going to place a bet that a bullish pattern is not going to violate that strike price. Just like selling the call options, and I showed you those patterns. Remember, I'm not long the stock, but hey, I want to participate in those bearish turning points. What we're going to do is sell an out of the money credit spread. And let me explain to you what that means. So like an insurance company, your insurance company sells you a yearly policy on your house or car for X dollars. They're accruing day by day revenue as long as you don't call them up to make a claim. That's what's called time decay in the option world. And we do it with phenomenal accuracy by using chart patterns. These are all pictures of bullish turning points, kind of the flip side of what we looked at earlier when you leg into a covered call. But those pictures above are the same pictures that we would be selling bear call credit spreads on. But here's the idea. I'll just focus on the bullish side. We're going to find bullish support, bullish turn. These are all pictures of them. We're going to sell an out of the money put. We're going to buy a further out of the money put. That send it as one order. That net credit is our potential maximum gain, which is ours to keep, as long as the stock closes above that short strike at expiration. And then we're getting paid day by day in managing these. We're making a prediction that these patterns are going up. So both as the stock goes up and time decay, and a third one, volatility contraction, but I'm not going to get into that today. That's our paycheck. And we have a phenomenal service, our weekly options trader. It does exactly that. It specializes in selling credit spreads around patterns like this with 10 days of expiration or less. So that time decay is like a fast melting ice cube.
We had a few at the end of last week and into this week already that are profitable and closed out.
Oh, absolutely. Yeah, we had 8. The last 8 wins have been in a row in the weekly options trader, except for today. We took a small loss on Adobe with the market weakness, but I think we're still in everything else. So I purposely grabbed this same shop example as above to show you I'm not long shop, but I want to participate in the trade. Here's how I do it. Same chart, same quotes. Here's a bear call credit spread. Greg, draw 155, please, and give me the old Greg opinion on this going above 155 in 29 days.
At what time? The star?
Yeah.
Okay, so if you're saying on the wide range bar down?
Yeah, so that would be the entry day, correct?
I would be pretty confident. I wouldn't bet your life on this one, Dan, but I'd be pretty confident.
Okay, but also keep in mind, everybody, Greg, please draw another line of the new horizontal resistance around 1.25. That is our new stop, folks, if not even a tad bit lower, the prior tail. Once we're in a trade, don't think that you have to go to sleep for 29 days and wake up and see what happened to your position. We manage these day by day. We send out, telegram alerts and adjusting stops, taking partial profits. So even though you didn't bet your life on it, I'll bet right there, if we did stop out, just based on my experience, I'll bet we would have stopped out at 90% of max profit. So let's look at the numbers here. We're selling that 155 call. We're buying a further out of the money call just for two reasons. One, it makes the maintenance requirement a whole lot less at the brokerage firm. And number two is if you have a catastrophic gap against you, it limits your loss. So we took in $2.75 a share. The broker's going to hold $17.25 a share, which is, you know, the spread width less the premium. As long as this closes below 155 in 29 days, I make the full 275 a share profit, over 20% return on capital. So I don't own the underlying, but that's the beautifulness of these strategies. We just sell credit spreads around bullish and bearish patterns, and we're getting paid for time decay and making a directional bet like this, and we just manage in between.
Okay. So just for those that are starting out thinking about options, what Dan is saying is there's two options. And
hey, no pun.
What's that?
No pun intended.
No pun. You're selling one that's more expensive and you're taking some of the money and buying one that's less expensive. That's the spread. And as long as it doesn't go past your closer strike, you get to keep the money. Simple.
Yep. So this is the link. Well, this is the product I was telling. Well, let me back up. The product I was telling you about was the weekly options trader, which is in our platinum package. But I put together a great little starter seminar on these credit spreads. So we have that offered in the silver. It's called Advanced Credit Spreads. It's 5 detailed chapters. This gold, I worked on it for over a year, and I just put so much more stuff in it. It has 12 comprehensive modules. Excuse me. So everything that we've just gone over on the credit spreads in here, not the covered calls, although there's a lot of similar concepts in terms of buying and selling options and using the charts to do it and trade management. That is a phenomenal course. 12 modules, $397. And then we had people say, well, now I want to go in your master trader green room, which is our live trading room, where we're finding these trades all day long. We're adjusting trades. We focus on gap trades, earnings trades, all kinds of stock and option trading. So we put together this platinum package where you save, I don't know, like $260 for doing that. So
let's get to the charts, Dan.
Absolutely. Let's do it.
All right, let me bring that up. Hold on. Where is my controls? All right. So you should all be able to see that screen. You can size it so that it's viewable for you. And this is how I go about scanning just for stocks that are going up and down. So from point of view, looking for stocks, well, there's two things that we would want to do here. We'd be looking for stocks to buy, and then we also look for stocks that are extended, whereas they could, be ones to sell either a credit spread, or if we own them, to sell a covered call. So in this scan, I'm first looking for stocks that are going up, and this is looking for stocks that are going down. And then I can sort them in these columns. So the master trader base, these would be basing, but be going up. Now, using an ADX is just an indicator. We don't need to look at it on a chart. It tells me how strong the trend is. And this RSI is just, it's very a subjective reference point of being overbought or oversold. But the combination of these numbers tell me within this list of stocks that I've come up with, which ones are more extended than others, or which ones might be going sideways and a little extended. So indicators on the chart, from my point of view and what we teach students, are pretty useless as far as indications of whether you should buy or sell. However, when you use the numbers as a calculation together, it can just shorten your scanning time. So, and then we have to look at the chart, of course. So a higher number here would tell me that that is more extended than, well, this one, right, which is basing and a little bit oversold. So we start going through these and looking at them. Now, what we could do is, if you have a portfolio of stocks and you're like, when is the proper time for me to be thinking about that? You could apply this watch list here, set up just like this, and looking at the numbers, and you would say, hey, this one's getting close. And say, wow, that is extended. And now you start going through other pieces of information as to whether it's the appropriate time to sell a covered call. And this one would say,
well, yeah, I mean, two things. One, on that one, yeah, that looks pretty extended. I would say, you know, it depends on how aggressive you want to be, but under a prior bars low, or, you know, a retest or something like that. But secondly, we don't just do it automatic. We go to the option table. We have to figure out how many days we want to give that right. But secondly, we want to make sure we're going to get paid for giving somebody the right to take our merchandise. Right. And we teach, you know, how to make that determination.
And we would look at an option table as simple as that one, and we'll say, well, what is there for 2 days? And you can see where it's trading, and then look at the option table and make a determination if there's enough premium to make sense to do that, whether it's to sell a covered call or to do a spread. And we have any indication here that this is ready to turn around. There's no topping tail, there's no retest, so that would not meet our criteria. And we start going through these and looking for those patterns. So extended can become more extended. So we look at multiple time frames. I would look at a weekly chart and see where it is relative to that. But while this is definitely extended, you can see that it started from a base, and here was a wide range bar igniting the move. So this gap up, which could have been on earnings, did get it a bit extended, and it's consolidating here. And this could be a situation, especially after earnings, where we might want to sell a covered call because of the way this spiked up. We'd look at premiums that are above this area.
Yeah, and secondly, into earnings, the volatility is going to spike, and it's a fantastic way to keep getting a partial hedge for any gap risk. Absolutely.
Right. So at different times, depending on the market environment and how the stock is moving, shorter expirations will have more premium versus having to go out to longer expirations. And this one, even at $18 at 23 days, has very little premium at all. So that's all part of putting it all together. BC's asking about KR. It could be. I would suspect that it probably doesn't have a lot of premium in there, BC, just because of the pattern. It's kind of very sloppy. And while it's retesting, I immediately would think, well, it's probably not going through $32. Let's go to a weekly chart. It's not going to go through $32 anytime soon. And then we go to the options table and see, is there any premium to sell in that amount of time? And so even at 9 days, there's nothing. At 16 days, there's little, not much. And with a stock as erratic as this, as long as earnings aren't coming out, I'd probably be willing to do it to bring in a little bit of money if I owned it. And you can see earnings are coming out in September 14th for this. As it gets closer to it, these premiums will increase. But this is the process. Now looking even at 23 days out, there's very little premium. But it's odds are, without a little bit of money, I wouldn't say it's a guarantee, but this stock pattern isn't one that suggests it's going to go up in the near term. Whereas some of these, depending on how they look, we can find stocks that do look like they're extended. And the pharmaceuticals are a sector that just got started and money is flowing into. You might want to take a look at the XPH, but this is making new all-time highs. And this, at some point, is going to be a very good stock for selling covered calls on. And then probably a lot of people would be doing that. It's a stock that people tend to hold on to long-term. And then same process. And say, well, here's something that's going to expire in 2 days. It's at $41. Even at $42 for 2 days, there's no premium. And so on. Now, how many days? What's the premium? How far away? All part of what we teach as to putting it all together. RPM. And so RPM, you can see here, it has a check mark under Master Trader Base. So this one we can see has been going sideways. And if you owned it, so everything is what covered calls is, do you own the stock? Well, if you do, then you can consider this as a strategy to lower your cost. So while this is going sideways, it is a little extended, and we do the same thing. Go to the options table and see if there's premium over what amount of period of time that we can take in that money. Let's take a look at a few more. And here's one that's interesting. Right? It gapped up, probably another earnings event. I think you're starting to get the idea here, but this is new all-time highs. And now this one, it's of interest to me because it's retesting, and I'd be interested to know if it breaks below there, and now we just set an alert. If that was to break below there, then we would go and look at the options to sell a covered call against this stock. Would make sense based on the pattern and the extension. I think you're getting the idea. Right? This one is pulled back a lot. So that would be late. But if you owned it because of the depth of the pullback, let's see where it is. That's quite extended. Because of the depth of the pullback, what you would look for here, since it's at support, the timing is not appropriate to do it. But let's just say it retraced to 30 and formed a bearish pattern, and you could sell a covered call up above 35. Is it making sense?
Makes sense to me.
Right. Well, putting together the patterns with the option strategies and learning how to put that all together, it becomes your investing and your trading plan. We do the same thing in different time frames. Whether, covered calls, you're not going to do that for day trading, of course, but the patterns that we teach all come together for whatever type of trader that you are. Dan, there was one question and this is something more that you would know. In YouTube, someone said they have a small account. Would they got approval for writing covered calls and writing cash secured puts and
Correct.
trading on margin? Would that approval work for $3,000 capital to start? But I'm kind of confused.
Yeah, it's what, I mean, there's no SEC minimum, so it's whatever the broker has set as, but I think you're fine for the following reason. A covered call, as we said, if you have enough money to buy the stock, all you're doing is increasing the probability of profit by selling a call against it. So yeah, every broker in the world should allow that. And then a cash secured put, selling it is really what's called the synthetic equivalent of a covered call. And here's what I mean by that. Let's say you wanted to own Apple, since that's what we're talking about. You could sell an at the money put, sell one contract, and cash secured means you have to have enough cash in your account to pay for those 100 shares. That's so if you're allowed to sell a put if you have 100% of the cash upon assignment. So synthetic equivalence of those two strategies means the risk, meaning your max loss, and your potential upside are identical. That's what a synthetic equivalent means. So yeah, those should be allowed with that permissioning.
All right. How much premium are we looking for, Dan?
A lot.
As much as possible.
Yeah, Maria, we have some guidelines. If we're doing a credit spread as a general rule, we're looking for at least 10%, 10 to 15% of the credit at the spread width. So for example, if you're selling a $10 wide credit spread, we want at least $1. And we want that for the shortest amount of time possible. We would love to get that, for 4 days, but up to 2 weeks or so is our general guideline on credit spreads. And on selling calls against your positions, I kind of have a rough rule of thumb of I like to get 1% of the strike price. So if you're selling a $150 call on Netflix or whatever, then I want at least $1.50. But also bear in mind that the higher volatility stocks that have inherently more volatility risk are going to pay you more than a boring, Merck or Johnson & Johnson or Procter & Gamble or Triple M. So, some of those slow moving slugs.
Right. And Amazon is one, if you time it correctly, with the patterns that we use would be good for selling covered calls.
Absolutely.
Yeah. Now, we're going to, covered a lot here, but since it was asked about selling puts, we could use this other column for doing the same thing and what's extended, but with the appropriate patterns. Now, the puts in this American Barrick Gold probably have some premium in them because of the way it's fallen, but is it ready to stop falling? So the idea here with selling an uncovered put, right, a naked put, would be to say, I don't think it's going down anymore because it's gone down a whole bunch. Now, if American Barrick was to fall down to $6, that probably would be a good bet. Right now, it's not. And we do the same thing, right? Ford continues to go down, but we can scan for these and find those opportunities. This one is a bit more interesting because it's retesting, look at the volume and so on. So this one actually, Dan, might be one that we could look at later today or tomorrow for a put spread.
I just typed it in.
Yeah, so. All right, everybody, I hope you've enjoyed this, learned a few things. If you have questions, email Dan or myself. either Dan at Master Trader, Greg at Master Trader, and join us again next Wednesday. And we'll do it all over again and teach you about another subject.
And sign up for a free 3-day trial to our green trading room, and you'll see what we do every day.
Yep. All right, everybody. Have a great.
Happy trading all. Take care.
Bye-bye.